Happy Friday. Today we are going to go through this chart that I saw on Twitter that I thought was amazing. And it really talks about the banking system, and it really lays out all the banks in a way that I think makes it very easy to see if your bank has higher or lower risk in the current market environment. And it comes from Michael Burry. I might have to switch back and forth and really show it along with some of the jargon that's in it. But I loved this chart so much that I snapshotted it and already sent it to a bunch of friends like immediately when it came out, to have this conversation with a couple of people that sometimes ask me directly questions about the banking system. But let me share it with you first. I don't know Michael Burry I don't know him personally at all. I do follow his Twitter feed occasionally. I don't even know if I follow his Twitter feed or if they just feed it to me, to be honest. But he's got really clever analysts, because this is a very money shot sort of chart. Now, my understanding is that he also went through this chart, but I think the context of what he went through may be very different than what I'm going to say. And hopefully between the two insights, there's something that's very easy to see. Now, he's using tickers on here. Some of you are hardcore stock gurus or just know to write the ticker down and go look it up in Yahoo Finance. Of these tickers, I would mention that by way of background, I do, because I cover the S&P, cover the majority of these. There's only a couple of these that I haven't listened to the quarterly call on the regular for a few years at this point. So those would be EWBC. I don't know that one very well. Bank of the Ozarks, OZK. I don't know it very well. It's not in the S&P 500. Pacific West, PACW. I don't know very well. And NYCB and WAL are the ones that I don't know very well. The rest I've been following along pretty straightforward. But I want to go through this and really explain it, because I do think it's very, very dense. There's an initial reaction that you can have. And then there's also a lot of takeaways on this that you really can stare at it a while. And even some of my smartest friends were like, May, I have some thoughts on this, but I wouldn't mind having you just give me a couple words on your side and then let's have a discussion. So it is actually that dense. If you looked at it and your eyes started to glaze, no problem. We're going to go through it. Disclosures. Hold on. Let me give the disclosures. That's like something that just has to be done. Past performance, not indicative of future returns. And I have some positions across these in like a number of different ways. Some of them are strangles because I think it could blow out kind of crazy. Some of them I'm just short. And then some of that using puts. And then others I actually have kind of like an alternative hedge on, definitely throughout the banks and financials, because the vol is so high. I like options. That's my cup of tea. So, I'm in them. And even though I say that, if you're watching this other than this weekend, my position could change on Monday. So let me just tell you that. So let's give Michael Burry again his Twitter. There's his Twitter, so that I give full credit, because I didn't do this work, he did, and I hate taking other people credit for other people's work. You can also read the comments that he does. It is Twitter. Knock yourself out. But let's just go through it. On the x-axis down below, we've got unreal losses as a percent of CET capital. And what is CET capital? That's the buffer that you have as a bank to pay out deposits that leave the bank. And to try to keep this simple, banks really don't hold that much cash in deposits. Usually or cash against the deposits, what they're usually doing is calculating what their daily needs for cash is. And then the Fed also mandates a certain amount of cash buffer, or tier one capital buffer. And the tier one capital buffer, a lot of that is actually available for sale. And so I'm going to actually show you this, because I definitely think that the way that people have been talking about this, some of them have just been saying it quickly. I don't want to say it, and then other people are just wrong. I really don't know another way to say it. And it's so important that you get this right to understand what's going on, because the jargon is extreme when we get to bank and bank regulated stuff. So down here, unrealized losses as a percent of CET capital. Here, my suspicion is what most people have been doing. Now, I didn't do this graph, but what most people have been doing is they've been going through the bond book, typically on the held to maturity side of it, and then taking that loss as a percentage of CET capital. It doesn't matter. That's actually totally fair and square. The thing that I take issue with is the fact that people are so focused on yes, it does include additional tier one capital, but the thing that I take issue with is when people are focused so hardcore on held to maturity and losses there, and then they just kind of miss this incredibly important point. So I'm going to share my screen and actually show you. I'm going to show you the notification that came about the offering that Silicon Valley Bank attempted to do just days before it collapsed, so that you can see very clearly why I keep saying the following, which is available for sale securities become held to maturity, or might as well be held to maturity during a bank run or during a period of severe liquidity issues. And let me just show you that documentation. This is just off the Silicon Valley website. Sorry. Okay, so it's off of Silicon Valley Financial Group's website, but oh man, did I not do this right? It's, if you look on their website, you'll see something called a mid-quarter update, and it's basically what they posted to demonstrate the sale. Slide 18 in that shows you that they did a sale of AFS, available for sale securities, okay? Not held to maturity securities, available for sale securities at 21 billion, but they took a $1.8 billion loss on that. Okay, that's really bad. Okay. And the reason that's really bad is that available for sale securities is supposed to be the stuff that barely takes a mark when you go to sell it. This is an 8% loss, 1.8 divided by 21 billion, right? And let me explain, this is the bond market. This is not the stock market where 8%, you're an option trader, you're like, I got out clean, I'm feeling good. No, you don't take losses like that in the bond market. That's why I keep saying it the way that I'm saying it. It's a big problem that happened. Okay. And no bank is safe given that happened. I've said that since the very beginning. I also want to show you this that also is in that deck, so that when I say stuff and it maybe doesn't match what other people are saying, you can kind of understand where I'm coming from and then force other people to prove where they're coming from. Let me say it that way. And where I'm coming from is this. This is actually strong capital. This was in the deck as well, okay? And so sometimes now, only just now, people are starting to say stuff like, you know, they, and by the people, I'm talking about the actual regulators who aren't allowed to give you as much spin as possible. So during the Fed conference, Jerome Powell said, you know, the speed at which they lost their deposits was a thing. And you can kind of see it here on this slide, which is slide 14. On slide 14, you'll see that the common tier one equity that they had was 13.88. During December 31st, it was actually 15.26%. And if you'll go back to my other videos, you'll see that at 15% in December, they were among the highest in the companies that were S&P banks. They were higher than literally more or less everyone else. Yeah. I mean, in fairness, you should also consider what people were taking for loss reserves, but let's just say it like this. They were much higher. You've got Wells Fargo, for example, hanging out at sub 11%. Okay. So, and then the actual CET requirement is historically 8%, but then it differs for too big to fail banks. So they were not, this is what it looked like just from even the asset raise from, and then this 12, like from the fourth quarter reporting to when they raised assets, they already had lost a significant portion of that CET buffer. Also, for context, I would tell you that I've been following along Credit Suisse, and you can go back and look at my Credit Suisse videos. You'll see that they also were buffering around 14% throughout the entirety of last year. And every time they would do a sale and then try to raise capital, they were just going from like 14 to 12 and then back up and back and forth like this. So the speed at which specifically Silicon Valley Bank took it on the chin is something that I don't think is well appreciated. I'm going to keep trying to give examples to help y'all out. Okay. Yeah, that's correct. That's totally right. You guys make sure to read the comments. We've got a lot of really cool regulars on my show that are posting great definitions to try to help people that are still trying to get all this jargon straight in their head. Now let's go back to Michael Burry's chart, which I think is just super stellar. Even just that chart by itself is so dense, it's not even crazy. Okay, so on the y-axis, we have unrealized losses percent of CET capital. Because I didn't do this chart, I don't know for sure, but my suspicion is that the timestamp of the CET capital is probably just after that announcement, not from December year end. And then the unrealized losses as a percent probably is more held to maturity assets, because those are the charts that I'm seeing floated around that would be readily available as data points. I don't know that people are doing the calculation on what it would mean to try to liquidate a massive amount of available for sale securities on the market as well. So that's what I presume is this x-axis. Even then, this is really kind of stellar as far as analysis goes. On the left, on the y-axis, which is also crazy good, like crazy cool, is the percent of deposits greater than 250% of total assets. Now, the press unrealized losses. Okay, so yeah, I'm seeing there's a request for further definition. What are unrealized losses? Yeah, you're right. I'm going to define both this side and this side. So let's go through jargon. Unrealized losses are simply principal marks on the bond. And this has to do with the nature of the fixed income markets that doesn't exist in the equity markets, except somewhat in the options market, but not really. Okay. But in the debt markets, what happens is that when interest rates rise, the principal component of the bond has to fall so that that really baby interest rate that they gave you matches out to something that makes sense in the marketplace. So all you need to actually create unrealized losses is an increase in interest rates. Now, it could be because there's actually an increase in default risk, but we know that's not true right now, because we have, by we, I really mean me, okay? Maybe other people also will tell you with great credibility that it's true, but I will tell you, if you'll go back to literally any of my videos on the financials in the previous quarters, we've seen almost no defaults, okay? And you can look around and you won't see a lot of defaults. The only thing that we've seen is principal marks. And that's why I keep, like, people think I'm picking on Upstart, but I'm not picking on Upstart, because it's just that the way that Upstart's financials happen to go show you very clearly what a held to maturity mark looks like. So go look at that video and see what I mean for even further clarification, because that's because of the nature of what they do. It's much easier to digest that word. But these are just principal marks on the bond. So even if you were to buy a bond from the bank, like a treasury, you would take a principal mark, but at the end, if you were allowed to hold it to maturity, you would just get your principal back, and then the interest rate, if it's got an interest rate, if it's zero coupon, you get just the whole principal. But during that time delay, technically you got to market to market. So unrealized losses in this particular context, as of right now, are just mark to market losses. Okay, they are. But if we keep playing this little game and we start having a whole series of defaults, those will not be mark-to-market losses. Those will be defaults, which is what it was in 2008. Thus far, very few defaults, mostly just mark-to-market losses, and then two banks that kind of took it on the chin hardcore. Okay, hopefully that made sense. But if not, let's make sure that you ask the question after I'm done talking so that we can then go back through it. Or I do have a little bit of a time limit because I have to fix dinners for some friends that are coming over. So, it's Friday. I'm trying to have a nice time too. Okay. So Silicon Valley Bank, as you can see, is in the far right-hand corner. That's how I know that this snapshot was probably taken closer to the March date than it was taken in December, because this was not necessarily how it would have looked at the end of the year. And you have 120% unrealized losses relative to deposits, hard stop. And then you have the percent of deposits over 250% of total assets. Now, what does that mean? Deposits greater than 250%. It means a lot of things, and you've heard about it, but we're going to go through all the meanings together so it's easy, so you could process it a bit. Over $250,000 means that you have more clients that have more than $250,000 liquid. Okay. So yes, 250 grand, FDIC insured, but let's just call it what it is. These are either rich people or wealthy companies. Okay. And then everybody kind of spins it in that direction, but that's not the most important thing. Like, it's important to the extent that we can collapse Silicon Valley Bank and pray that it's actually done there and with Signature Bank of New York. But what makes it bad Yeah, me too, Jennifer. But like, but like, what made, I mean, because this is liquid, right? We're talking liquid, okay? I mean, yes, IRAs would also be incorporated in deposits greater than 250% when we're looking at this number. But we're talking about liquid cash money here on deposits for the most part, that on how this particular calculation would wind up. So we're talking about companies that are trying to make payroll. We're talking about really wealthy people that just haven't had time to figure out if they want to have 3 different bank accounts. Stuff like that is what we're talking about here. Okay. The other thing that's really relevant is that if you have most of your people greater than 250,000, so uninsured, then it doesn't take as many people to walk out the door for you to have a bank run. That's what a lot of people are ignoring in this chart that I think is crazy important. Okay. It's crazy important. With Silicon Valley Bank, you didn't need many. That's why when people say, like, hey, that Peter Thiel saying what he said, that wasn't cool. I tend to agree with him. Do I think, I mean, should he have like made sure that his own investments? Yeah. I mean, like, you got to protect your own, right? In some ways, I get it. It's kind of nasty. But then like the way that this reaction went down and stuff like that, it ain't cool. So Silicon Valley Bank, that's it was a little bit of an outlier, but we don't know when this snapshot was taken. Okay. It was probably taken just after they did that asset raise and people just started pulling like crazy. Signature Bank, this is the one people are ignoring and have kept very quiet, and they shouldn't, because look at where it sits. It sits like in the same plane as a ton of banks. Okay. That's what is scaring the bejesus out of me and a lot of other people. And here's the thing is, okay, like we can say, oh, Signature Bank did not diversify its assets, its client base enough. But let's call that client base what it is. That's some wealthy people. Wealthy liquid people is what that is. There's never been a point in history where wealthy people would have caused you, with no default risk, would have caused you a problem. But because the nature of a bank run, right now, wealthy people that can have their choice of banks is actually causing you a problem. Do you know what I mean? That is what this chart tells me. And also when I ran it by a bunch of my other friends and like kind of I've seen a couple of similar charts to it, that's what that implies. So, okay, that's not great, because the other one that all of us know is in the news right now is First Republic, right? You can kind of see that it's got a bunch of wealthy people that are their base. And originally, when I wasn't processing this as fast, and then this chart came out very quickly after, you can go look at the date and when it was originally posted relative to when Silicon Valley defaulted. When I saw this chart, I was like, my bad. It doesn't matter how much you deposit in that bank. You got to make sure that there's enough capital in case like just small amount of people decide to move on. That's your problem with First Republic, and so on and so forth. So everything above this 60% of their depositors is a problem. So that also does imply US Bank, because US Bank, look at this, is like actually in the wrong spot if we're to say that it's safer than Signature Bank. Okay, but I don't want to be like the FUD of banks, right? Okay, so possibly, I'm not the only one looking at this chart. So there's a lot of people who are looking at this chart and probably trying to solve this problem. But I do want to acknowledge how amazing this chart was as far as what it's trying to tell you. Okay, so that's that. Now, it does imply that these guys, even though each one of them has their own special sauce of interestingness, these guys have a lot of small depositors, each of which is insured by FDIC. That's what it means to be like underneath this, lower in this line. They've got more depositors that are insured by FDIC, and also they have a little bit more cash money is really what it is. Or the types of assets they have in theory don't have those bigger losses. So a lot of folks on this held to maturity, okay, I'm just going to tell you now, all the banks that I look at in the S&P 500, they don't have crazy whack-a-madoodle stuff on the balance sheet, okay? So it is this chart showing you unrealized losses is mostly showing you the like stuff that you might have bought in 2000 because you were trying to match the time series of your deposits. Deposits have walked out the door, and so now it's decreased your buffer. So what do I mean by that? Okay, a lot of people have been really nasty about Silicon Valley Bank buying the 10-year treasury because of what they call duration mismatch, which means they should have foreseen that customers that they've had for like years, decades would walk out the door all at the same time. Like that's what they're actually saying. So, I think Silicon Valley was maybe a 40-year-old bank. some of their customers have been with them for 40 years. And so matching that duration isn't actually the craziest thing. Taking a 10-year piece of debt and matching it to clients that have been with you for over 10 years, it isn't the most whack-a-madoodle thing out there, okay? So realize that that's what we're talking about. So this calculation is mostly, in my opinion, probably duration mismatch related, meaning this kind of mismatch potential that was bought in 2000, 2 years ago, let's call it 2020, right at COVID to now, and we've raised rates so aggressively. Okay. So that's most of what this is. There may be some, like, it's hard to know the extent of the analyst that did this because there's lots of depth that you could have done it. If he did a quick and dirty, it doesn't even matter because that's already amazing sauce. So full props there. But that's kind of, so over here, they probably did a tighter job with matching duration risk. I'm going to say it that way. Hopefully those vocab words don't crush you. And then over here, slightly less good job from this line over to the right. And then up here, you still have that big client risk, okay? And so that's the density of this. You guys can have a look at where your bank falls. If you're over here, have a backup plan. If you're over 250, let me say it that way, just let's have a backup plan, okay? I'm not saying do a run on bank yourself or rip money out. I'm just saying have a backup plan. Additionally, if you're over here, you also may want to think about a backup plan. Probably nothing wrong with these guys, okay? But at the same time, it could be weird. Now, I have every faith that there's some really sharp, smart nerds that are on this. And with that, I'm going to stop sharing. Let me see what's going on in the chat. Try to take some questions. Say shout out to Caitlin, who's my favorite person. We do a Runescape room together sometimes because we both love that video game. In case anybody wants to join that sometime, find me. Lawan Williams, you rock. Thank you for being as well very interactive on my Twitter. I appreciate your comments all times, even if I get a little bit more sass on my Twitter. Jennifer, thank you for coming. If I have a joint account, yeah, that's right. Totally true. Thank you for making that comment because a lot of people don't realize that joint accounts are actually covered in a slightly different way. So that's perfect, Jennifer. Thank you for that footnote there. Good. You shouldn't, Jay. You shouldn't. Don't dump your accounts. But I've told everybody that it may be clever, just in case it takes a little time to get the money out via FDIC. Why don't you just take a little extra cash money and just put it somewhere? I mean, if you're in a rough neighborhood, don't do that. You know what I mean? But like if you have a safe in your house that's hidden, maybe you just take a little bit more cash money out. I love RuneScape. But that's a story for another time. But I will be starting a RuneScape channel called Runescape with May. So you'll just have to look for it. I may pin it down below. So if you want to find me, but I'm doing that with Caitlin, and we had to restart our RuneScape account. So we've been at it at a month, but I have like a whole philosophy of RuneScape that I think is amazing. This game started from 1999. It's now here. It's this one that I'm responding to. It's now like owned by the Carlyle Group. I'm intrigued by why the Carlyle Group, this private equity firm, has bought it. It's very, very cool stuff. But we talk about all things RuneScape there. So if you're a lover of that game, I will pin it in the show notes. Come find me. Yes, James, I love that you have a safe. Let's see who else do I want to give a shout out to because I don't want you guys here too late. You guys should have fun. Israel, thanks for showing up. Yeah. All right. I wish I was coming over for dinner. That sounds delicious. Hadouken. All right. I'm not seeing too many questions. I agree, Caitlin. It does teach us about economics. All right. Yeah, this is exactly right. I do want to highlight this comment that Hadouken posted because, yeah, that's totally right. That's exactly what we're talking about. Available for, like, a lot of the press too, and we've gotten kind of used to it, but a lot of the press is also abbreviating these things really fast, like a bit available for sale. And so that is super cool stuff because in theory, yeah, you're 100% right. It should literally be like the difference between using your credit card and using cash at Walmart. And then suddenly someone's going to charge you 8% for using your credit card. That's essentially what happened to Silicon Valley Bank when they went to go sell their available for sale. So it's kind of crazy. All right, cool. We're going to keep this short so everybody can depart and have their Friday night activities. Thank you so much for stopping by, and definitely subscribe to my channel if you haven't already, and give my Twitter some love. And also my Instagram is also Markets with May. Take care. Bye.